July's inflation print coming in line with expectations.
Investors are calling for the Federal Reserve to cut interest rates at its next meeting in September.
A reduction in our policy rate could be on the table as soon as the next meeting in September.
And with the mere mention of having rates drop this year, it caused the Russell 2000 index of small cap stocks to spike up 10%. This is because small cap companies rely heavily on borrowing to finance their operations for growth. And obviously, when the Fed drops their rates, there's this expectation that these small cap companies will begin to grow at a much faster rate because they can now afford to borrow money to fuel that growth. Plus, most investors think that the S&P 500 has been running pretty hot lately, and it needs to cool off, which I think all of us saw with the pullback a couple weeks ago. And as a point of reference, the Russell 2000 has had strong inflows in just the past few weeks, and that will continue more and more as the rates begin to actually drop, and not just the mere mention of it. Here's the thing. I believe that there's still plenty of time to get in with small cap ETFs or exchange traded funds, especially now that we're starting to see some pullback in the market. Me personally, I try not to invest in individual small cap stock very often, unless of course I know that they have a very strong path for growth with solid financials. In my opinion, the best route for investing in the small cap sector is in the form of ETFs because it spreads out the investment across dozens or even hundreds of companies. Without a doubt, it's a risky segment with very strong potential for growth, and that's more reason to be smart about investing in it through an ETF. But once again, that's just my personal opinion. And as a reminder, small cap companies are those with a market capitalization typically between $300 million and $2 billion. Every time that you get a ride with Lyft, then that's an example of a small cap company. Or if you happen to have an off-road Polaris or see people driving around town in them, then that of course is another example of a small cap company. So if you're interested in the best small cap ETFs for potential growth for when the interest rates do drop, then I'll be covering them right here in this video. And I assure you that I do have a few that you haven't even considered. And I don't expect a person to invest in each and every one of these funds. They all have very different strategies, so I'm trying to showcase all the best options for you to review and research them further on your own. And of course, if you feel like there's one that I should have had in the video, then please share it in the comments. I'll get started with the first one of Avantis US Small Cap Value Fund with a symbol AVUV. This is an actively managed index fund with an expense ratio that is relatively low at 0.25%. With its focus being on the value companies, it specifically seeks out companies with a combination of low prices relative to the fundamental value measures and with high profitability. The managers adjust the weights for each company in the fund based on their value and the profitability traits. For this reason, the index is predominantly made up of the sectors of financial services, industrials, and consumer cyclical. But you'll also notice that they purposefully stay away from real estate and utilities. And I also want to point out that being classified as a value company, well, it doesn't mean that it's a better investment. It merely means that based on those financial metrics, these companies appear to be trading at a lower valuation compared to their peers. Inherently, the desire is that it has obvious room for growth, but please know that that is never a certainty. This happens to be a great fund to kickstart the video because when you look at the performance, it is beating the S&P 500 in all three timeframes. The trailing 12 months at over 16% is decent, and the 3 and 5 year CAGRs, or compounded annual growth rate, is at over 10 and 15% respectively, so they happen to be very solid. The expectation is that they will have a lot of room for growth when the rates do come down. This fund is fairly popular, and if you haven't heard of it, it does have over $12 billion in assets, and I believe that an actively managed fund in the small cap sector, well, it may not be a bad idea based on their performance. One of the things about small cap ETF is that they're working with smaller, sometimes newer companies that are pushing the boundaries of potential growth. Sometimes new funds don't get any credit because, well, they lack a history and they simply don't make the list. So I'm going to throw out a bonus fund of TEMA GLP-1 Obesity and Cardiometabolic ETF with the symbol HRTS to get it simply on your radar because it has a lot of small cap companies in it where the focus is on companies that are fighting weight loss and obesity. Now, it does have a couple of huge companies in it like Eli Lilly and Novo, where GLP-1 drugs are very hot right now. But there are several small cap companies in it like Mereo Biopharma that has a strong buy with analysts with a 67% upside, just to give an example. Look, here's the thing. Obesity in the US is out of control, where 42% of adults are clinically obese, but only 5% are being treated. Should that number double to 10% being treated, then there is huge potential in the sector, and 10% doesn't seem like much. That's why obesity and cardiovascular care is estimated to quickly be a $500 billion opportunity. And biotech has been following the small cap trajectory, where the down cycle, well, it happens to be ready for growth when the rates are reduced. As I'd stated, this HRTS fund, well, it happens to be very new, but it's up 13% year to date and up 29% since inception with an expense ratio of 0.75%. And analysts give the fund a strong buy with 46% upside for the next 12 months. It's just a bonus fund to look into. The next fund is the Invesco S&P Small Cap 600 Revenue ETF with a symbol RWJ. This fund is interesting because it's the top 600 small cap companies weighted by their revenue. And there's a max cap of 5% per company within the index. And when we look at the weighting of the sector compared to the prior Russell 2000 Value ETF, consumer cyclical moves to the top for RWJ along with industrials. And technology also makes up a much larger portion of this revenue-weighted ETF. This slight change in strategy does make a fairly big difference in the performance of the ETF over the trailing 12 and the 3 and the 5 years, where they are all comparable to the S&P 500. But at a 5-year CAGR of 16.6%, well, it does happen to beat out the S&P 500 by over 1,500 basis points. Over 5 years, that difference definitely adds up. But then again, the conditions need to be right for small cap stocks. And that's why I believe that the next 1 to 5 years should be very good for small cap stocks. And if you are interested in dividends, this ETF pays out at 1.28%, and it is a fair amount less than the prior ETF, which was at 1.85%. And I'll move right along with the next fund of Vanguard's Small Cap Growth Index ETF with the symbol VBK. I think that this is one that many of you may be familiar with if you happen to have an existing small cap ETF in your portfolio. This fund is indexed to the CRSP US Small Cap Growth Index, which looks at multiple aspects of growth for a company such as future long-term growth, short-term growth, 3-year historical earnings per share, sales per share, investment to asset ratio, and return on assets. Now, because of its focus on growth, the top sector of the fund lies heavily with technology, industrials, and healthcare. And one of the most notable parts of this fund is that it has the best expense ratio of the entire group at 0.07%. This is a solid small cap ETF that I think is going to check the box for many of you out there that just happen to be looking for that growth sector within small cap. And when you look at the performance, it is slightly lower than the prior revenue ETF of RWJ for all the 3 different periods that, well, I've been looking at today. This fund happens to be extremely popular and it has over $17 billion in assets, where it isn't necessarily the best in performance, but the low expense ratio does make it very attractive for many people. But as I always try to state, keep in mind that the total return already has the expense ratio taken into account, so it's been removed. So keep that in mind with your research. I believe that this next fund will be very polarizing, but please just hear me out and let me explain why it's on my list. The next fund is the iShares MSCI India Small Cap ETF with a symbol SMIN. So you may be wondering, Brian, why are you focusing in on one country other than the United States? I get it. Let me explain. India is the 5th largest economy in the world, and they are the fastest growing within the top 10 economies at a 7% growth rate. In fact, it should overtake Japan on the list by this time next year. There's a very good reason why so many private equity groups and large corporations are investing heavily into India today. India happens to be in an economic boom as they're benefiting from a young, expanding population with a rise in manufacturing, which is very evident when you look at the sector weight, with industrials being the top area at over 25%. Now let's take a look at the performance, where the trailing 12 months is the best of the group at over 37%. And the 3 and the 5 year, they're also extremely good at over 14 and 19% respectively. But I have to say, for a passively managed fund, the expense ratio is the highest today at 0.79%, which I am not in love with. But overall, I believe that this is a great fund to invest into India and its future growth. This is easily one of those funds where in 10 years, you may be kicking yourself for not investing just a little bit into it when you had the chance. And the next fund on my list is the First Trust RBA American Trust Renaissance Fund with the symbol AIRR, where the strategy is to track the performance of the Richard Bernstein Advisors American Industrial Renaissance Index, where the top sectors by weight are over 82% industrials and then only 10% in the financial services. The whole purpose of the strategy for this fund is to concentrate their 45 holdings into the potential benefits that the US is going to be seeing by reshoring manufacturing back to the homeland. And this strategy happens to be paying off quite well, because when we look at the trailing 12 months, it's up over 25%. And the 3 and the 5-year CAGRs, well, they're both over 19%. To put that into perspective, $10,000 invested 5 years ago in this fund, well, it would be worth over $26,000 today. And that had been over $7,000 more than if it were in the S&P 500. I would have never have thought of a fund that focuses on industrials having such great growth. But that's why I love researching all of the different concepts and the ideas for my videos. It gives me a chance to uncover funds that I simply wasn't exposed to with my current news feeds or what I'm reading today. And I certainly hope that I showed you a few options that you hadn't even considered before. And as always, I have a spreadsheet with all the different funds that I had considered in today's research. I certainly hope that I earned a like for this video, and I also hope that you'll consider subscribing to the channel and sign up for my free newsletter. Thanks so much for watching.